Hi, welcome now to the video on the periodic inventory system with the LIFO cost flow assumption. This video follows on four others, the three using the perpetual inventory system, and then I've also done one with the periodic system using the FIFO cost flow assumption. Now we're going to do the LIFO cost flow assumption. As always, same facts. I hope that you will reread the facts. Overall, we have 1,000 basketballs available for sale during the month of January. And in the end, we sold 450 of them, and we have 550 in ending inventory. And our whole chore is to use the cost flow assumption to find out how much cost we assign to the 450 balls sold and the 550 balls in ending inventory. And at this point, I hope, as always, you will pause the video and work this case now under the periodic system, assuming the LIFO cost flow assumption. I will see you in a moment. And welcome back. Hopefully you found that easy. And I'm going to be pretty brief here because it's with the periodic system, it's not a heck of a lot different than FIFO. The only thing that's going to differ is the adjusting journal entry at the end of the month to record the cost of goods sold and the ending inventory. So once again, we have the purchase of 200 at 28. Key here being that we are using the temporary purchases account to record those purchases. We also have the sales that occurred on January 10 and January 25. Nothing new there. And that brings us to our entry at the end of January. This time, periodic system, LIFO cost flow assumption. So as always, step one is to zero out via a credit the beginning inventory balance and the purchases balance. And then step two is to establish the cost of goods sold and the ending inventory balance. And here's what it looks like. You may do either first and then the other will be the plug. If you chose to do the ending inventory and set it up, you found that we have 550 balls in ending inventory, and the LIFO cost is the 400 that were oldest in there, bought in 2023 at 25, and the 150 bought at 28 early in January. That was the 400 times 25 plus the 150 times 28 is 14,200. And when you take 27,600 minus 14,200, you get the cost of goods sold of 13,400. Or alternatively, you know that it's LIFO, so the cost of goods sold is going to be the 550 balls, 400 at 30, that last purchase, and 50 at 28, the second to last purchase. And that is what in the adjusting journal entry will look like under a periodic system with the LIFO cost flow assumption. And in the last video, we will apply the average cost using periodic. Here's what those financial statements look like. Great. And as always, I thank you for your attention, and I will see you in the last video in the series, that is periodic, with a periodic system, average cost flow assumption.